What happens when ambition and greed collide? Jordan Belfort, famously known as the Wolf of Wall Street, is a name that has become synonymous with excess, deception, and redemption. From his meteoric rise in the financial world to his dramatic fall and eventual imprisonment, Belfort's story offers valuable financial and ethical lessons. Hi everyone! Today we'll explore how Jordan Belfort built his empire, the tactics he used to deceive investors, and the critical lessons we can learn to navigate the fine line between success and morality. By the end of this video, you'll understand why his story serves as both a cautionary tale and an inspiration for transformation. Let's dive in. Jordan Belfort grew up in Queens, New York, where his entrepreneurial ambitions surfaced early. As a teenager, he reportedly earned $20,000 selling Italian ice on the beach. This early taste of financial success fueled his desire for wealth. After a brief stint in the meat and seafood sales business, which ended in bankruptcy, Belfort entered the financial sector in the 1980s, a time when Wall Street was ripe with opportunity and corruption. At Stratton Oakmont, the brokerage firm he founded, Belfort built a culture of aggressive salesmanship and relentless ambition. His ability to motivate his employees earned him loyalty, but his methods were far from ethical. Stratton Oakmont specialized in selling over-the-counter stocks, which were not traded on major exchanges and were often volatile. Belfort's pump-and-dump schemes inflated stock prices by creating false demand, leaving unsuspecting investors with worthless shares when the prices crashed. By the early 1990s, Stratton Oakmont was one of the largest over-the-counter brokerage firms in the United States, but its foundation was built on lies and manipulation. Belfort's charisma played a significant role in his rise. He created an atmosphere of high energy and invincibility at Stratton Oakmont, making his employees feel they were part of something bigger than themselves. However, behind the scenes, his substance abuse and reckless behavior painted a different picture. Luxury yachts, private jets, and extravagant parties were staples of his lifestyle. His drug and alcohol addiction fueled this reckless behavior, further entrenching him in a cycle of self-indulgence and financial deceit. His personal life was equally chaotic, marked by failed relationships and conflicts stemming from his substance abuse. Belfort's life became a cautionary tale of how unchecked greed and ambition can spiral into self-destruction. At the core of Belfort's financial empire was the pump-and-dump scheme. This fraudulent practice involved acquiring large amounts of stock in small, obscure companies, then inflating their value by creating a false sense of demand. Belfort's brokers used aggressive, high-pressure sales techniques to convince unsuspecting investors to purchase these stocks at inflated prices. Once the stock price reached a peak, Belfort and his associates sold off their holdings, causing the stock's value to plummet and leaving investors with worthless shares. Belfort's straight-line persuasion system played a pivotal role in the success of these schemes. The system emphasized psychological manipulation, building trust, and creating a sense of urgency. It was designed to close deals quickly, leveraging the emotions of investors to bypass their logical scrutiny. While the system was a masterclass in sales, it was also a blueprint for exploitation. Brokers were trained to create rapport with clients by pretending to have their best interests at heart, while carefully steering conversations toward closing the sale. This technique allowed them to sell stocks that were often completely unworthy of investment. The toxic culture at Stratton Oakmont further enabled these practices. Brokers were incentivized with lavish rewards, from cash bonuses to expensive cars and trips, for meeting aggressive sales targets. This created an environment where unethical behavior was not only tolerated but celebrated. The firm became infamous for its debauchery, with stories of wild parties and drug use becoming almost as legendary as the fraud itself. These practices fostered a cutthroat atmosphere that prioritized profits over ethics, turning Stratton Oakmont into a breeding ground for corruption. Belfort's tactics extended beyond sales. He employed an elaborate network of shell companies to launder money and evade detection by regulators. These shell companies were used to hide the illicit profits generated by his schemes, making it more difficult for authorities to trace the funds. This level of sophistication highlights the lengths to which Belfort went to maintain his fraudulent empire. His manipulation of financial systems was so advanced that it took years of investigative work to fully unravel his schemes. The downfall of Jordan Belfort began as complaints from defrauded investors mounted. The Securities and Exchange Commission, or SEC, and the FBI started investigating Stratton Oakmont in the early 1990s. The firm's suspicious trading patterns and numerous violations of securities laws drew intense scrutiny. As investigators delved deeper, they uncovered a web of fraudulent activities, including insider trading, money laundering, and stock manipulation. In 1999, Belfort was arrested and charged with multiple financial crimes. Facing a lengthy prison sentence, he chose to cooperate with authorities, providing detailed information about Stratton Oakmont's operations and implicating his colleagues. His cooperation resulted in a reduced sentence of 22 months in federal prison. During this time, Belfort began to reflect on the consequences of his actions, recognizing the devastation he had caused to thousands of investors. The collapse of Stratton Oakmont marked the end of an era of excess and corruption on Wall Street. The firm's implosion also prompted significant changes in financial regulations, including stricter oversight of brokerage firms and increased scrutiny of over-the-counter stock trading. Belfort's story became a symbol of the dangers of unchecked greed and the importance of ethical governance in the financial industry. The regulatory aftermath of Stratton Oakmont's collapse serves as a reminder of the critical role that oversight and accountability play in maintaining the integrity of financial markets. Jordan Belfort's story offers numerous financial lessons for investors and professionals alike. One of the most important is the necessity of due diligence. Many of Stratton Oakmont's victims failed to investigate the firm's practices or question the unusually high returns they were promised. This highlights the importance of researching investment opportunities thoroughly and seeking independent verification of claims. Another critical lesson is the danger of succumbing to high-pressure sales tactics. Belfort's brokers were trained to create a sense of urgency, persuading clients to make decisions without fully understanding the risks involved. Investors should always take the time to evaluate opportunities carefully and consult with trusted financial advisors. Diversification is another key takeaway. Many of Belfort's victims concentrated their investments in a single stock or sector, leaving them vulnerable to catastrophic losses. A diversified portfolio can help mitigate risk and provide more stable returns over time. Ethical behavior is perhaps the most significant lesson from Belfort's story. His short-term gains came at the expense of his clients' financial futures, ultimately leading to his downfall. Transparency, honesty, and adherence to ethical standards are essential for building sustainable success in any profession. Belfort's story serves as a stark reminder of the long-term consequences of unethical behavior. Belfort's journey is also a story of redemption, albeit a controversial one. After serving his prison sentence, he began rebuilding his life by acknowledging his past mistakes and sharing his experiences. Through his books, including The Wolf of Wall Street and Catching the Wolf of Wall Street, and his motivational speaking career, Belfort has sought to educate others about the dangers of greed and the importance of ethical decision-making. His efforts to repay his victims, though criticized by some as insufficient, demonstrate a commitment to taking responsibility for his actions. Belfort's post-prison career has focused on promoting ethical behavior in business, offering lessons on how to achieve success without compromising integrity. While opinions on his redemption arc vary, his story underscores the potential for change and the value of learning from one's mistakes. Belfort's tale also highlights the human cost of financial fraud. His actions devastated countless lives, eroding trust in the financial system and leaving lasting scars on his victims. His story serves as a powerful reminder of the ethical responsibilities that come with success and the need to prioritize the well-being of others over personal gain. Jordan Belfort's rise and fall is a story of ambition, greed, and redemption. It's a cautionary tale that reminds us of the importance of financial literacy, ethical behavior, and the need to question too-good-to-be-true opportunities. By learning from his mistakes, we can navigate the financial world with greater awareness and integrity. Thanks for watching. Let me know in the comments what you think about Belfort's story and whether redemption is truly possible. Don't forget to like, subscribe, and hit the notification bell for more deep dives into financial stories and lessons. See you in the next video.